Not only are interest rates skyrocketing, it's now going to become more difficult for you to be able to purchase real estate. There are some new regulations coming into effect by OSFI that could affect your ability to purchase real estate in 2023.
Some of the things that we're looking at are minimum debt servicing across your entire portfolio, changes to stress testing, and changes to loan to income and debt servicing as well too, so stay tuned.
Hey guys, Josh Findlay Ehren from the Findlay Mortgage team. Today's video we're going to be discussing some new regulations that have been proposed by OSFI and how they are going to affect your ability to scale real estate moving forward.
We want to take a look at some proposed changes that are coming to the mortgage lending world. These changes are being potentially put out there by OSFI. So OSFI is the Office of the Superintendent of Financial Institutions. So basically they are the regulatory body that oversees all federally regulated financial institutions. So a couple of years ago, if you're familiar, there was the Bill B20 that came into effect. It took a look at a few things such as like down payment changes, stress testing, and removing some of these like no income type mortgages. So they are the body that kind of brought that bill out. And with the way the economy has been moving, and the mortgage market that is out there right now, they want to take a look at some more proposed changes that might help kind of tighten things down and kind of safeguard the economy.
One of the proposed changes is to incorporate a loan to income factor into qualifying for a mortgage. For someone who doesn't know what this is, essentially what this is the banks will take a look at the total amount of debt they can give you based off of how much income you make. It's a little bit different than your total GDS and TDS ratios. What they do is they take a multiplier of the total income you would make. Let's say you made $100,000, they would only be able to give you $400,000 of mortgage if you had a 4 times multiplier. The Canadian government tried using this type of mortgage qualification with one of their CMHC products a little while ago. It was a complete disaster. It didn't work because affordability just wasn't, the people who were using these products weren't able to afford the homes they were trying to intend to purchase.
Yeah, I think the toughest part of trying to institute that is you take a look where the average home is. If you got a $600,000 home, does the average income even allow you to get there if you're looking at, like a 4 or 4.5 type multiplier? They haven't, stated specifically what that number is, but 4.5% or 4.5 times your income was what the limit was on that first time home buyer incentive that they were offering.
It's pretty crazy because last year, essentially, we were seeing at 8, 9, 10 times people's income. And unfortunately, if you kind of rewind a little bit, 4.5 times multiplier is probably where you should be. But in today's market, it's not realistic of how somebody could afford a home or buy a home in southwestern Ontario.
Yeah, I mean, if you're looking at a $600,000 home and you got a 4 to 4.5%, that household income, you're looking at $150,000, which isn't too far off where you kind of need to be able to afford something right now. But taking a look at the overall income of Canadians, you're not quite there, maybe getting close to combined, but still just gives you an idea of what they're looking to do.
The way that OSFI proposes new legislation to their industry partners is they ask questions and they table it to some of the largest banks, and then the banks come back and answer the questions, and then policies created around that. So we wanted to outline some of the questions that OSFI is asking based off the point we just discussed. So question number 1 essentially was, what are the views on new lender level volume restrictions on high LTI lending? So how should an LTI threshold be determined? Essentially meaning like what multiplier should financial institutions allow the average person to be able to use when purchasing a home? For example, should it be 4? Should it be 5 times your total income? This is something that they're probably weighing on right now. Now, Aaron and I, before shooting this video, were discussing there's a lot of factors in life that aren't factored into qualifying for a mortgage. One being, gas, food, expenses that were nominal, about 12 months ago, which are now skyrocketing because the cost of living is going up. And I think that this question is coming to the banks banks because those additional froth costs in your financial budget for the economy wasn't something that was drastically affecting. It wasn't like a large payment that they were factoring in, but now that the cost of living is drastically increasing, I think this is bringing up the question of, do you need to change the qualification rates to be able to factor in these crazy high costs of living? So from the perspective of a bank, you would think that a bank would want a higher LTI because it allows people to be able to purchase more of a home. But in reality, a higher LTI actually puts a bank at more risk when lending money. So you have to ask yourself, from a financial institution's perspective, where they're a for-profit organization, they also have to mitigate risk while also trying to keep, one of their largest lending products afloat. So I think that there's going to be a lot of deliberation on this and how this is going to affect the housing market moving forward. Personally, if we take a look at where the multiplier was, in the last decade, 4.5 to 5 times your total income to purchase a home was reflective of the market at the time, but this needs to be adjusted based off of where markets are at right now and where we see the next cycle going, because this is going to affect people's ability to be able to purchase maybe a new home or even an investment property moving forward.
Yeah, I think the biggest question with this is going to be, we already see that income, the increase in income doesn't match the increase in inflation that we were seeing in the housing market. And if they were to implement a strict 4.5 times, if income isn't increasing and we get back into probably inevitably another market that's going to, increase at a higher inflation of value, how does that impact someone buying a property?
If we were to look at a crystal ball and figure out or try to determine where this is going to be or where OSFI is going to land, the previous framework that they used for the first-time home buyer incentive program was a complete fail. Nobody used the product because the affordability wasn't there. I think that it's going to have to be higher than the 4.5 that they previously had in that product if they want to implement a framework that's going to allow the average Canadian to purchase a property.
So the second point that OSFI was looking to regulate is potentially some changes to your GDS TDS ratio. So GDS TDS is our standard debt servicing ratios that we use for all residential mortgages. The two ratios take a look at your income to house related costs and then your income to your total debt costs. So some of the proposed changes that they were taking a look at was potentially adopting insured ratios in underwriting for uninsured. So if we're taking a look at insured mortgages, you're really limited to two ratios. 35 and 42, so that's GDS TDS ratios if your credit score is 650 to 679 to 680, and then if your credit score is above 680, the extended ratios allow you to get up to 39 and 44, so GDS TDS ratio. So taking a look at some of the lenders out there, there are some lenders that can be a bit flexible. Some of the A lenders, for Scotia example, do allow you to extend these ratios beyond 44 if you have overall good characteristics of the borrower, so credit score, income, all these factors play into there. Some of the uninsured lenders out there as well too, you can get up to 50, 55, 60% depending on the lender. So just sounds like they're really looking to potentially just kind of tighten this all down and try to keep one uniform type standard of calculating GDS TDS. One of the other changes they were taking a look at was, are they going to change the way you actually calculate these GDS, TDS? So maybe adding in, some sort of different types of debt, or changing up the structure that way. Obviously, just maybe trying to include more in there from an overall perspective of living expenses and factoring in maybe a few more expenses that they don't already consider. And then the third option that they were talking about was an explicit amortization schedule on qualifying. So to me, this sounds like they might be considering something like, always qualifying at a 25-year amortization, even if your contract is going to be 30, 35 or 40 year, pretty similar to what they're doing with the interest rates right now. Whereas if you're qualifying at a 5.5%, or sorry, your contract rate is 5.5%, your qualification is 2% above, so 7.5%. So, and I think the main reason why they're probably considering this is, most of these investors, if you get into a B loan at 30, 35, 40, we're really trying to use that amortization to help kind of get you in and ease your affordability. But most of the investors, you're out of this product within 1 to 3 years. So it's great that you have a 40-year AM, but that's not going to be consistent with your long-term mortgage. So I think they're just trying to kind of crack down on that.
Yeah, there's a lot of, if you've watched any of our content, there's a lot of strategies in being able to purchase real estate, and whether it's a rental offset, whether it's higher amortization schedule, there are having many strategies and ways to be able to scale rental portfolios, and I think that the risk associated with people having multiple properties in an inclining interest rate environment, there's some cracks starting to show, and that risk is starting to become a serious concern for the regulator, and they're going to try to find ways to be able to reduce that risk by either making you qualify at a higher level or reducing the availability for you to be able to offset rental income in a way in which we've seen it for the last little while, which I believe is going to push a lot of real estate investors out of the residential market into commercial financing. We already see it in the States. Those DSCR ratio loans is becoming more prevalent on the res side. We do have them here and we use them extremely effectively here, and there's going to be a shift towards those type of investments, or that way in which people do invest, because if OSFI decides that they want to crack down on the res side, basically your personal income, people are going to start looking at alternative solutions to purchase real estate. Lastly, point 3, OSFI has tabled a interest rate affordability stress test requirement. The third tabled point that OSFI has brought to their industry partners is the interest rate affordability stress test. Essentially what this means is they believe that variable rates, adjustable rates, and lower term rates have a higher risk to the average consumer than what a longer term fixed rate mortgage has. Do I agree with this? Definitely not. But it's important to understand who is being asked these questions. Let's say, for example, a 5-year or 10-year fixed rate mortgage would have a much higher interest rate differential cost to break than a variable rate, adjustable rate, or a lower term mortgage. If you take a look at who's being asked this, aka the banks are the ones who have vested interest in people taking their loans. The banks profit more from a longer fixed term mortgage, and they also profit from people breaking these types of mortgages. One of the challenges right now with the market, and if we take a look at what happened in the hype of last year, values of property were skyrocketing and people were consistently turning over cash, taking variable terms, breaking the terms, buying other real estate, and so on and so forth, and that caused a run-up in real estate. I think that what OSFI is trying to do is they're trying to mitigate the ability for people to do that, so they're going to put in safeguards or make it more difficult for people to take more flexible terms or shorter terms to reduce the velocity of capital in the market. I think that this would definitely be a barrier for real estate investors who are looking to complete the BRRRR, because it's going to penalize you for taking something that's more flexible and something that's going to allow you for a shorter term. I think we're going to have to see exactly what the framework's going to look like for this, but anybody who's looking for more flexibility might be penalized moving forward, which could definitely damper a few of the investment strategies that have been prominent in the last 2 years.
So one of the other questions they're kind of looking at, still under this stress testing, is the potential to essentially stress test an entire application. So if you're buying a property, and interest rate is 5.5%, they're stress testing that at 7.5%. They also want to take a look at the remainder of your non-subject properties and stress test all of those mortgages, again, just to be able to essentially create an overall picture of understanding if your subject property is going up, so are your non-subject properties. So again, if you got 5.5% interest rates across the board on your non-subject properties, we're also going to be stress testing those mortgages at 7.5%. I understand what they're trying to do, and I guess from their standpoint, it makes sense in theory. If you're stress testing one, the same principles could be applied to your non-subject properties. It's really tough. I guess we take a look at everyone who just hit a trigger rate or was in a variable rate. It was tough enough for them to be able to afford on the applications as it was. With those interest rates going up, it's just going to make it that much more difficult. If you're saying 2% above or whatever it is, whether or not they apply that unique type parameters. If you got variable rates and fixed rates or opens or whatever it is, and you're getting different sorts of qualification percentages added to those, it's definitely going to make it a bit more difficult. I think it's going to make it a bit more challenging for individuals who really live off their credit cards and their lines of credits, and every year, want to go in and refinance their home to pay down that debt. It's not obviously the most fiscally responsible way to kind of live your life, but there are a lot of individuals out there who unfortunately just need to live on this type of method, and it is pretty common. We see quite a few of that. So I mean, it's definitely going to have an effect on those individuals. And in terms of continuing with this stress testing, they also want to take a look at potentially adding this stress test to other non-mortgage retail loans. So I think what they're talking about here is other types of personal lines of credits, credit cards. I don't know if this would be applied to any sort of like student debt or car payments, but it's anything essentially non-mortgage in retail. So it looks like they're really just trying to just slap a general affordability stress test, kind of across the board on everything. We did just see the entire economy, interest rates rising. You take a look at if your prime rate goes up, it's not just affecting your variable mortgage, it's affecting your home equity line of credit, your unsecured lines of credits, any other credit card debts, anything that revolves on this prime base rate. Everything is impacted. So again, I see both sides to it. Unfortunately, I understand what they're trying to do. Is it too much too late? Depending on how quickly they want to implement these, it could almost do more harm than good. I think if this is something that you want to implement, you have to kind of let everybody settle, kind of get themselves out of these high interest rate debts. I mean, if all these people who just renewed, especially some of the alternate lenders where you could be high 7s to 8% right now, you throw into these these new qualification tests, you really do limit these borrowers trying to be able to get these higher interest rate debts down to some of these lower interest rates that are going to be coming in the future. What kind of impact does that have? So I think it's going to be crucial to understand how they're going to implement it, if this is something they do move forwards with, and hopefully they maybe add in some grandfathering or something to allow people to get out of these higher interest rate debts.
Yeah, I think it's important to understand, guys, that this framework is outlined in a way in which it's open for interpretation. This isn't something that is law. This isn't something that is actually outlined and it's going to be happening right now, but these are the questions that they're asking the banks at the moment, and these are things that they're tabling and things that they're thinking about doing. This is how we've interpreted these points, and just make sure that when this does come out, we will outline this in greater detail as a definitive kind of framework and outline moving forward. But this is our interpretation of what we believe their questions are referring to, and how they are planning to move forward in 2023. This could happen as early as April, May. These things do happen quickly, and if they do think the economy needs it, that they will act on it efficiently and swiftly. Last but not least, we want to talk about what does this mean for purchasing moving forward, and how would these new changes affect people's ability and investment strategies. Essentially, there's a few ways in which investors are already looking at this, and the writing's already on the wall. Affordability is already challenging on the A side, and it's even challenging on the B side right now, just where rates are at, and the economics around purchasing residential real estate. Buying a single family home with a rental property right now, a lot of people are seeing this as risky. Rates are high, payments are high, and if somebody stops making their payment, that's very much a you problem now, and not as much an investment, more of a liability. So we're starting to see a shift to multifamily real estate, a duplex, even a triplex and a fourplex, that allows you to at least reduce risk if someone stops paying. And in economic times where inflation's high, people lose jobs, rates are high, you go into recession, that is a real risk for investors right now. I have clients who own properties, who own duplexes and triplexes, where people just aren't paying and you're on the hook for a $5,000 mortgage payment. These are things that you need to take into consideration. If these do go into effect, I do foresee people moving directly into the commercial space. This isn't necessarily outlining how commercial financing works, and if you take a look at who regulates some of the lenders that are big players in this space, credit unions are huge players in the multifamily space, and even on the res space, but more in the multifamily space for us. And it's important to understand that they aren't federally regulated. They follow their own framework guidelines. So they're not qualifying on Bill B20, and if this came into effect, that they may not have to qualify based off these new stress tests, which is kind of an advantage to using these types of lenders. So there might be a huge shift from investors working with these A banks into credit unions and creating more relationships, and pushing you towards working with brokers who understand how these types of financing work. I think as we progress and the regulatory framework becomes more challenging to be able to purchase property, working with a broker who truly understands different types of capital, how to transition in and out of them, different types of lending, different loan to value requirements and debt servicing requirements. I don't foresee Canada's landscape getting easier to purchase real estate moving forward, and finding those strategies and working with the banks and that can help you scale are going to be paramount in the success of you being a real estate investor.
Yeah, I think in terms of who investors are going to go to work with, I think it does start to push people away from the banks a little bit. We already hear enough that bank mortgage guys, they're looking at just the one specific transaction. They're not trying to take a look at your entire portfolio and set you up for success long term. And if they start implementing some of these debt servicing changes and stress test qualification off your entire portfolio, it means now that every single mortgage you get has to be considered as an overall view of your whole portfolio and long term thinking. It's also going to stop some of these investors from just going out and snaking up as many lines of credits as you can, because if they start adding stress testing to non-mortgage debt on your applications and you have 6 lines of credits, how are they going to start taking a look at that? So it's definitely going to require you to work with someone who's going to take the time to sit down, take a look at everything, factor in all of these different points, and put you in a pathway to success. So it's going to change the lending landscape a little bit.
Yeah, no, we understand this was a lot to take in and soak in. So if you guys have any questions about how this might affect you moving forward or what's going to be happening with this, feel free to reach out to both Ehren and myself. Our contact information is down below. You can also find us on Instagram. We're always available, usually 24/7, 365. Again, if you have any questions, feel free to reach out. Once this framework is put into play and we do know more definitive answers about it, we'll make another video outlining exactly the requirements for this and how this is going to affect you moving forward. If you did like this video, please hit the subscribe button, smash the like button. It allows us to be able to create more content like this for you to be able to continue to purchase real estate moving forward. Thanks, guys.